This is Greg Strange with the first of a series of summer and autumn briefing podcasts from the IoD. And today we're talking with the IoD Chief Economist and Director of Policy, Graeme Leach. And the subject is the housing market. Graeme, critical to the economy.
Indeed it is. It's critical to us personally because after all we all want to know what the outlook is for our own individual property values. But from a broader macroeconomic perspective, it's probably very important for three key reasons. The first of these is that obviously rapidly growing house prices just gives a general sense of well-being in the economy, and consumer confidence is boosted. So that's an important number one. Number two, I guess we're talking about the fact of wealth factors, and obviously you feel wealthier and therefore you may have a higher propensity to spend at the same time. So that feeds through into consumer spending. And the most direct way, of course, is the fact that with rising property values, people have more equity in that property, and they can release some of that equity. And we see that all around us with, new kitchens, expensive foreign holidays, as people liberate some of that value from the property.
Okay, I can see why it's important, but is the current market overvalued? Everybody keeps on telling us, the doomsters in Fleet Street, that it is.
Well, that's a straightforward question, but not a straightforward answer. If you look at a very simple measure, then the housing market looks very, very substantially overvalued. The ratio of house prices to incomes is currently around 6, compared with a long-term average of around 4. That's substantially overvalued. But one has to say that it was showing very high readings 18 months, 2 years ago, and house prices have been relatively firm since. You can't just look at an index like that, the ratio of house prices to incomes. You have to look at slightly more sophisticated measures. The Institute of Directors has constructed our own housing affordability index, and that shows that the market is overvalued, but it's not quite as overvalued as maybe many fear. It shows the market's overvalued by around 35% at the moment compared to the long-term average. But that's against a sort of peak, let's say 1989 peak, of around 67%. And the good thing now is that in the future, as the interest rate cycle turns late 2008, then affordability should improve substantially. So one of the key factors here is actually the interest rate factor. It's not just the house prices alone.
Now, you did just mention there the late 80s, that time, and the early 90s, there was a blip, a correction, whatever you want to call it. What's the difference between the situation then and the situation now?
Two very big differences between the housing market now and in the early 1990s. The first of these is the fact that although inflation is rising at the moment, it's at a much lower level. Inflation nudged 10% in the early 90s. Now we're well below 3% still. So the magnitude of the inflation problem is less, and as a consequence, obviously interest rate pressures are less. Although we've taken on a lot more debt, so it doesn't mean that low interest rates are the whole story there. But the second crucial factor is the fact that we're not in the ERM anymore. In the early 90s, domestic circumstances were screaming for interest rate reductions, and we couldn't reduce interest rates because we're in the ERM. Clearly we're not now, so it's a different story.
So what's the outlook for the housing market next year?
Well, where angels fear to tread, I'll try and wade in. The outlook, I think, is for what you might call a hiss rather than a pop. A slowdown in house price growth, but not outright falls in prices, and that's a big difference. What we won't be seeing, I don't think, maybe outside of some localised markets, is a generalised fall in prices. In the early 90s, they fell by more than 10%. I don't think we're going to see that now. What we're going to see is a plateauing off in house prices, and over many years, maybe 3 to 4 year period, and maybe over that period they'll rise less than incomes as well. And what you will see is affordability improve gradually over that period. I don't think we're going to see a short, sharp shock where prices fall and really the turnaround comes within the space of 12 or 18 months. I think we're talking about an extended resolution of the housing market overvaluation at present. But that's still a pretty good story. We've had sustained high growth for a long period of time, and so a flat period is pretty good news, actually.
Graeme, thank you very much.